Welcome back, everybody, to Volatility Trading Strategies. So in part 1 of this AMC options trading video, I went over the 2 worst ways to trade these types of high-flying stocks. Now, obviously there are worse ways to do it, like say selling naked call options, for example, but after years of warnings from me, nobody in my community would be reckless enough to do that, right? Right? So the first trade you shouldn't be doing is buying long put options. When people think a stock is overvalued, the long put option is often their default strategy. But the problem is the implied volatility is so sky high right now that those contracts are just way too expensive. We call that the Vega headwind. And the stock would have to crash so far so fast to overcome it that it just makes it a very low probability of success. It would be like buying real estate in the frothiest, most expensive market and then wondering why you didn't make any money long term. Well, you paid too much. Those premiums were just too high. And the second trade you shouldn't be doing is selling short put options. In this case, people often think that if they sell the options far enough out of the money, then the stock is surely never going to get to that point and they can just collect a nice easy premium. What they overlook is how much that premium can rise on them day to day if the stock starts to drop or implied volatility goes even higher. Even though it doesn't get to their way out of the money strike price, it can still put the trader several 100% negative in a very short period of time and force the position to be closed for a big loss anyway. So today, let's talk about a couple of trade ideas that do have a higher probability of success. And it doesn't just apply to things like AMC. They can be used as a template anytime you want to participate in something but not risk losing too much. So do me a favor, it just takes a second. I'll keep making the videos if you keep smashing that like button. I think it's a fair trade. So just to frame this so people watching in the future know what we're talking about here, this is AMC stock over the last 2 years. Before the pandemic, it was in a range of $7 to $10. In the heart of the quarantines and business closures, it dropped as low as $1.91. But recently in 2021, AMC is up over 2,000% and reached a high of $72.62. This type of action is what's causing a lot of people to want to jump in and start trading it. The problem is there just aren't that many ways to do that safely. In my opinion, the only trades that people should be considering on these types of momentum stocks are defined risk option spreads. There's a few advantages here that make defined risk option spreads much better choices. First, the defined risk part means that we know ahead of time how much we can make or lose. The maximum loss is capped, which does make risk management pretty easy. Just don't risk more than you can afford to lose, and then you can still participate in the stock. Second, because they are option spreads that include both long and short strikes, we don't really have to worry about that sky-high implied volatility, or how quickly the implied volatility can change, both up and down. By holding both long and short options, it somewhat negates things and removes one variable from the equation. And lastly, margin requirements and buying power won't be changing throughout the life of the trade. This is something that a lot of newer traders overlook, but it can be devastating when it happens. With defined risk spreads, the health of your account should remain consistent as the trade is open, even if it's going against you. So the second trade I'll talk about is much more fun, we'll get to that in a minute, but the first trade is a very good default for newer traders when they want to participate in something, but they don't want to risk getting blindsided by the options market. So this first trade is called a long put vertical, also sometimes called a bear put spread. It can be thought of as the trader just drawing a line in the sand where they think the stock is going to go, and then selling your trade at that level. So just as an example, let's assume the trader thought that AMC was worth about $20. How would they come up with that valuation? Well, like I said, before the pandemic, it was trading at about $7 to $10. I don't think a very strong case can be made that AMC is somehow a better company today than it was last year. But because it has a lot of momentum behind it, it is also unlikely to get back to this same level. So let's pay our respect to the power of the Wall Street Bets crowd and say that we think AMC is worth about $20, twice what it was before. And we think it'll dip back to that level within a few weeks. So if we go to the option chain, if we give this trade a little bit of time, maybe select this July contract expiring in 39 days, we can open a long put vertical at this 25 strike. So open a vertical. I'm going to adjust this 24 down to 20. And this is what that trade looks like. This is the shape of a long put vertical. You can see down here it's comprised of both a long put strike at 25 and then a short put strike at 20. So we don't have to worry about the implied volatility problem anymore. And it's also a defined risk option spread, where we can only lose the money that we put up. Now, this premium is going to be bouncing around because the market is live right now, so try to ignore that. But in this case, the premium is about $1.80. For options, one option contract is equal to 100 shares of the underlying. So each one contract costs about $180. $175 now, but again, it's going to be bouncing around, so bear with me. That's the maximum loss over here. No matter what happens, no matter how high AMC goes, the trader can't lose more than that. The maximum gain happens below $20. That's over here. Remember, with our fairly crude valuation there, we think the price is going to go below 20 within 39 days. Now, if that happens and it does end up over here, you can see the profit is as much as $322. That's a pretty good risk-reward profile, risking 180 to potentially be making 320. And the maximum loss is capped. Again, we're just drawing a line in the sand where we think the price is likely to go. You could do lower if you want, and it actually increases the amount that you can make, or you can make it conservative at a higher price, and it might get closer to a 50-50 risk profile. Now, if you do think AMC is going to rocket higher, you could also do long call verticals. Vertical spreads themselves have different variations, and they can be used to set any threshold and any price bias you have. I just use the long put vertical as an example of a person who thinks the price might be going to about 20. But you can do anything you want. The vertical spread itself is definitely one of the safer choices out there. So the second trade we're going to talk about has both a basic version and then an optional, more choose-your-own-adventure aspect to it. I use these quite a bit in what I call my directional flies strategy, and it works really well in all stocks and indexes, not just the AMC and GameStop madness. So now we'll delete this one. And again, we're going to use that same July contract. It expires in 39 days, but this time we're going to open what's called a butterfly spread. So I'm going to buy a butterfly at this 40 strike. And this is what the butterfly looks like. Now, this is just a tiny sliver of profit, so I'm going to have to adjust these strikes. I'm just going to go up to the 60 for this one, and then down to the 20 for this one, just as a baseline example. So now this is more like it. This is what the butterfly option spread looks like. On each side of the trade, that's where the maximum loss happens, and then all of this range in the middle is where we make our profit. Again, this is going to be bouncing around. Don't worry about that. So above 60 and below 20, those are both the maximum loss areas at about $440. This centerpiece is the profit range, and it does top out at $1,500. Now, the odds of it hitting right there are pretty low, but of course, anywhere in this wider range is going to be fine for us. And again, importantly, this is a defined risk trade, so we're never going to be surprised and lose more than we thought we could. The other advantage is that we are using both long and short option contracts, so again, we don't have to worry about that volatility component. With the price right here, this trade is just a bet that it's going to go down, but not too far to breach the lower wing. Now, this whole thing can be moved around. You could do it lower if you wanted it centered around that 20. You could do it higher if you wanted it centered around today's price. This basic trade can just move around based on where you think the price is going to go. But a really cool variation of this trade is called the broken wing butterfly. If you haven't seen it, it's pretty cool, and this is probably going to give you a lot of ideas to run with in the future. So let's say you're a person who thinks AMC is going to go down, but you're more worried about it staying high than crashing down really far. If you think the Wall Street Bets crowd will be able to keep this thing up, you won't need to worry about it dropping all the way down here. So we can actually break one of the wings of this butterfly. We can move this 60 strike down to, say, 55. So now what we've done is we've transferred the risk from the high side over here and put it down to the low side. It doesn't fundamentally change the structure of the trade. This is still a defined risk spread. But now up here, I can only lose $55 if it stays really high. And now on the low side, I can lose $555. Still got that nice profit range in the middle that peaks out at about $1,400. So this is the range we're looking for. But again, I've just decided that I'm more worried about AMC staying higher than crashing down lower. I don't want a whole lot of risk on the high side. Now let's reset this back to our baseline at the 60. And now let's imagine a person who's confident it's going to go down, but they're actually worried it is going to go down a lot. In this case, we can break the other wing. We can move this 20 strike up to the 25. And you can see what happened. Now, the high side of the trade above today's price does have the risk. Got that nice profit range in the middle, and then very low risk to the low side. We could even make this low side 0 if we wanted. Let's say we just went to the 27 strike. That would do it. Now there's no risk down here, and it's all 100% risk above today's price, which is right there. Still want it to drop, but if we're quite worried about it ending up all the way down here, it makes sense to move all of that risk over to the high side where we don't think it's going to go. Moving this back down to the original baseline case, you can see why the butterfly spread is so much fun. We can use it to put the risk and the reward anywhere we want. That's why I say it's kind of a choose-your-own-adventure style of trade. What do you think's going to happen? And then you just structure it to best represent that. And the best part is, it is defined risk, we don't have to worry about the volatility, and the margin in your account should stay consistent. So to review these good trades, vertical spreads. In my example, I used the long put vertical, but again, any variation can be used depending on your opinion of where AMC is going. But verticals are really good trades and quite user-friendly because they are easy to understand. You decide on a price level you think it's going to be at, and then you set your numbers there. The best part is if you're completely wrong, it's not that punishing because the maximum loss is capped. And the second trade, a personal favorite of mine, is the broken wing butterfly. Same concept, we need an opinion of where we think the stock is going, but we can custom design where the maximum gain is, and also what side of the trade we want less of the risk to be on. The direction we're more worried about, we can shift that risk to the side we're less concerned it will reach. It's a very customizable type of options trade. So obviously be careful out there, these are not trade recommendations. We're just talking about some trade ideas to get you started on that path to being profitable. Because that's the key to successful options trading. These are not lottery tickets. It is a risk management tool. So if you need a little structure in your investing and you want a little help on those lines, make sure you claim your free trial on my website and join us here in the VTS community. You're always welcome. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.